Chapter 20, Manufacturing Accounts. Manufacturing accounts are prepared by manufacturing companies to show the cost of producing goods. Now, these accounts are prepared before the income statement. Please note, before the income statement. Now, trading companies purchases finished goods, but a manufacturing company purchases materials it uses in the manufacturing process. Now, one important thing to note is that the cost of goods manufactured, that is the total cost, is transferred to the trading section of the income statement, and it replaces the figure for purchases which would be found if the business is buying and selling wholly completed goods. What this means is that when you prepare the trading account, then that time you write opening inventory plus purchases. So the purchase amount, that is the cost of goods purchased from outside, this is getting replaced by the manufacturing account figure. That is the total cost which you find from preparing the manufacturing account, because the company itself in its factory is producing the goods rather than buying from outside. Now, manufacturing accounts has three main costs, that is materials, wages, and overheads. Overheads represents expenses. Now, the expenses can be divided into two, that is direct cost and indirect cost. Direct cost is the cost which can be directly attributed to producing or manufacturing of that product. This includes direct materials, direct labor, which we'll see further in the video. And indirect costs are those which are the production costs that cannot be directly associated with the produced or manufactured unit. It is basically the cost incurred from running of the factory. Includes heating and lighting, etc. We'll again see this in the further video. Let's see some definitions. The direct cost which we saw earlier is divided into three, that is direct materials, direct labor, and direct expenses. Direct materials are the materials from which goods are made. It includes carriage inwards on raw materials. This is an important point to note and remember. Direct labor are the wages of the workers. Direct expenses are the costs which have to be paid to the other person for the right to produce the products or to use their processes. This payment is often a fixed sum for every unit of goods produced. It includes royalties, license fees, etc. Now we represent direct materials by DM, direct labor by DL, and direct expenses by DE. Now what is prime cost? Prime cost is the total of the direct materials, direct labor, and direct expenses. That is the total of direct cost. Now the indirect cost which we saw earlier is also divided into three, that is indirect material, indirect labor, and indirect expenses or overheads. Indirect materials are all purchased for the factory but which do not form part of the goods being produced. It includes cleaning materials or lubricating oil for the machinery, etc. Indirect labor are the wages for all the factory workers who do not actually make the goods. It includes factory managers, supervisor salary, stores staff, cleaner salary, etc. Indirect expenses or overheads are the costs relating exclusively to the factory and the production. It includes factory rent, heating, lighting, depreciation of factory building and machinery, etc. Now, what is factory overheads? Factory overheads is IM is indirect materials, IL is indirect labor, and IE is indirect expenses. That is the total of indirect cost. Now, let's see the inventory. The inventory for the manufacturing company is divided into three, that is raw material, work in progress, and finished goods at cost. Now, raw material is simply the material required for the production. Work in progress are the goods in the process at the end of the previous year but which are not finished. The key word is which are not finished, i.e., it is semi finished goods. the goods which are work in progress. And finished goods, mind, whenever you are entering the amount for the finished goods, it has to be at cost. Now let's see the most important part of the chapter, that is the steps and the format. Now the steps are: first, from the trial balance which will be given to you in the question with mixed all the figures and everything, find and mark all the direct expenses and the indirect expenses. Basically, it will be given you all mixed, you need to bifurcate it. Then finding the prime cost, that is the total of all direct costs. Now also let's simultaneously see from the format. So now in trading account, when you prepare the normal trading account, you also do the same procedure, that is opening inventory of raw materials. The only difference between this is that in trading account you did it for the finished goods, and here in the manufacturing you are doing it for raw materials. So opening inventory of raw materials and purchases of raw materials. Now one important thing to note here is that you may have to add or deduct accruals or prepayments in respect of raw materials purchases when calculating this purchase cost. Then less purchase returns from materials, add this is carriage inwards on raw materials, then less closing inventory of raw materials. All of this will give you cost of raw materials consumed, that is cost of RMC, raw materials consumed. Now after this you can write the total of direct labor and direct expenses given you in the question, and the total of these three will give you the prime cost. Now next step is to calculation of factory overheads or indirect costs. Now factory overheads over here. This comprises of indirect materials, labor and other overheads. Add all of these three to get total of factory overheads. Now next step is the adjustment for work in progress. Now work in progress inventory we saw earlier. Now what you have to do is that take the opening balance of work in progress, that is at 1st January whatever the year given in the question, add that and then less the work in progress at 31st December, that is the closing inventory. This is the closing, this is the opening. Let's subtract that to get the net adjustment of work in progress. And then now one thing to note here is that this figure can be both positive and negative. So no worries. If it is positive, just add the prime cost, factory overhead, and then the net adjustment, or if it is negative, then subtract it. The addition of all these three, that is the prime cost, factory overheads, and net adjustment of work in progress, will give you the factory cost of finished goods or cost of production. Now the next step is the calculation of factory profit. Now this is an important concept, understand that properly. So factory profit is over here. Now what is this factory profit? It is the percentage to be added to the cost of production as profit. This amount is decided by the management and will always be given in the question if necessary. There may be cases where it is not given and it is given as a percentage maybe, or it is the figure that you need to find, but these questions are very rare. Mostly it will always be given to you. It is supposed to be debited in the manufacturing account, that is added in the manufacturing account, and credited in the income statement. So nothing but in the question they'll just give you as a percentage means nothing but they'll give you in the question that the factory profit is 20%. So after calculating the factory cost of finished goods, that is the cost of production, you just calculate, for instance, 20% of this factory cost. This is the cost of production. So 20% of this. 20% of this figure will be this figure, the profit figure. And then the last step, that is just to add these two, you get the cost of goods transferred to trading account of the income statement. And you're done with your manufacturing account. Now, a next important part, that is unrealized profit included in the inventory of finished goods. Now, this may come as an adjustment in the question which needs to be done. So, unrealized profit is nothing but the factory profit or the profit getting included in the closing inventory of finished goods. Now, we need to reverse that and remove that profit element. This unrealized profit is included in the closing inventory of finished goods. As I said, this factory profit is not supposed to be realized or earned by the company until the goods are sold. It must therefore be excluded to arrive at the actual or realized factory profit. And the concept of realization must be applied to do so. That is nothing but reversing the amount to exclude the profit element. Now let's take an example. The inventory of finished goods at 31st December 2020, that is the closing inventory, is 92,000. This is 115% of the cost of manufacture. Now this percentage will be definitely given in the question. So no need to worry about that. So now let's see how to do this. Now as the profit of 15%, that is 115, the addition to 100 has been added to the cost of 100, as I said, 100%. Then the unrealized profit will be calculated as 92,000 into 15%, the unrealized profit percent, upon the 100 upon 115, which is equal to $12,000. So this means that the income statement includes, this is not 9, this is $12,000 of profit which is not to be earned until the goods have been sold, and so must be shown as an expense in the income statement. Now let's see the overall entry, that is the double entry for unrealized profit. That is, debit the income statement and credit the amount to the provision for unrealized profit account. Now this is only when there is an increase in the provision for unrealized profit account, and the opposite of this, that is credit the income statement and debiting to the provision for unrealized profit account, this will be done when there is a decrease in the provision for unrealized profit, and these debit and credit will be by the amount, that is with the amount of increase or with the amount of decrease. Now let's see the format for the provision for unrealized profit account. Now here you start with the balance brought down, that is the opening of the provision for unrealized profit account. So that will be 12,000 over here. Then the balance carried down. Now this, in the future years, it will be necessary to adjust this provision for unrealized account for the increase or decrease of the closing inventories. So let's say in the year 2021, 31st December, whatever the amount of closing inventory is, that into the same procedure 15 upon 115, whatever the amount is, that will be the closing provision for unrealized profit. And the difference of both of these will be taken to the income statement. Increase, if it is an increase, then it will be on the credit side. If it is a decrease, then it will be on the debit side. And this balance carried down will be just taken to the opposite side while closing the ledger.